Joined right now by tax expert and CPA Paul Dion from smarttaxadvisor.com.
Yep.
Thanks for stopping by.
Thank you for having me. Appreciate it.
Now, with the recent tax changes with the new administration, there's some big stuff that came down the pipe. Let's talk about first the homeowner.
Okay.
What changes should they be aware of?
But there are two changes that they need to be concerned with. The biggest one has to do with mortgage interest. What's happened is if you have an old mortgage, the rules have not changed. You're still going to be able to deduct it up to $1 million plus another $100,000 if you have a home equity line. What has changed is if you refinance or get a mortgage after the 25th of December, the 15th of December, what ends up happening is you have to limit the interest deduction to the first $750,000 of principal. Anything over that you can't take a deduction for. The other issue is home equity lines. The first thing that came out was that home equity lines were completely non-deductible. The IRS has since come out with a ruling and indicated that if the home equity line is for purchasing the home or improving the property, then it's still deductible. If, however, the home equity line is for clearing up your credit card bills, going on a vacation, those things aren't deductible. Quite frankly, we don't know how the IRS is going to manage knowing which is which, but that's what the rules are at this point.
Seems like a definite gray area there.
Yes.
And in regards to that date, so for anybody that has bought a home or refinanced prior to December 15th, 2017,
right,
this doesn't impact your loan.
Correct.
Moving forward. It's just new mortgages.
New mortgages, correct. So, and also, if let's say you have a home, you've got a mortgage that fits the old criteria, and you choose to refinance for whatever reason, it's probably still a good idea to do that because of the interest rates, but you have to recognize you now become subject to these new limitations.
Okay. And for the person that's just looking to get a home equity line moving forward, if it's used to purchase the property, which is called a piggyback,
right,
mortgage,
or to fix up the property, then it's going to be deductible. The
But
interesting
consolidated.
strategy we're suggesting to people, if they're also renting property, you don't have the same limitations on rental property. So a lot of times it may make sense when you're looking at your entire portfolio to put the mortgages in the home equity line on the rental property instead of your personal residence, because you're not subject to these limitations.
Interesting. Okay, so that's major change number one.
Yes.
You said there's a second one.
Well, there's a second one that has to do with state taxes. What happened was the first House bill said that they were going to limit real estate taxes to the first $10,000. A lot of people still are hearing that and believing that. What's happened, they made it worse. And what they said was state income taxes, real estate taxes, auto excise taxes, poll taxes in some states, that entire total amount is limited to $10,000 now. So a lot of people are coming to me and saying, oh, my real estate taxes are below that, I don't have to worry about it. And I have to remind them, if you live in Massachusetts, Rhode Island, California, high tax states, we're all going to get impacted by this $10,000 limit.
Okay, good to know for sure. Flipping to the real estate agent, I know that's a niche part of your business. You work with
Right.
a lot of real estate agents. You've written a book about it. What should they be aware of come tax time right now?
Probably the first good thing that's come out of this is that there's now something called a qualified business income tax deduction. And what it amounts to is you calculate your net income on your business, and then you get to subtract 20% of that before you calculate the income tax. It doesn't change the self-employment taxes, but it does change the income taxes that you have to pay. Now, the challenge with this, by the way, is since I have an issue with agents, is the National Association of Realtors has come up with an opinion that realtors don't qualify for this deduction. And I disagree with that, and almost every tax accountant I've talked to disagrees with this. Okay. And it has a lot to do with the fact that there's a provision in the law with it. If your reputation is involved with it, you can't take this deduction. So if you make net income under $315,000 as a married person or 157.5 single, regardless of these special rulings, you're going to still take the 20% deduction. When you go over those limitations, then things like accountants and lawyers can't take the deduction, but I believe real estate agents can. So that's going to be an important impact for them.
Bottom line is that if you're a real estate agent or self-employed person with all this stuff, you need somebody like
Right.
yourself to help you navigate
Right.
this.
Yeah, and the other important thing I forgot to mention is that there's a misunderstanding that you have to be incorporated to take advantage of this deduction, and that is incorrect. So if you're a sole proprietor, LLC, or S corporation, this deduction is still available to you. So don't rush to create an entity that you don't need to. There are other reasons to consider it, but this particular situation, you don't need to do that.
Okay, and as a business owner, if they're trying to figure out the best entity to form for their business, that's something that you can help out with
Correct.
as well.
I try to avoid the legal side of it, but I tell them what they should be talking to their attorneys about, what should they do for a structure. I want to focus on the tax advantages of whatever the structures are. And there are some opportunities for considering entity creation to save them money, even under the old law, which is still in place in a couple of instances in the new law. So that's important to pick up.
And lastly here, just kind of switching it to the real estate investor.
Okay.
I know you recently wrote a book, The Real Estate Investor Tax Guide. You can check it out on Amazon.com. There's different tax laws that have gone into effect for this niche.
Well, you know what's interesting? The House bill was about to do create some problems for the real estate investors, and when they finally got the final bill, it actually took away this stuff. I was sitting in late December, holding off on some strategies for clients, waiting to see what the tax law was, and the good news is that they didn't mess around with this. The big one had to do with 1031 exchanges, which is a like-kind exchange. We thought they were going to kill it, and they did not. What they did is they limited it to real estate. So like-kind exchanges for business or for trade-in of vehicles has now gone away, but like-kind exchanges for real estate is still there. So that's kind of the important thing.
That's key. Great information. Once again, you can check out the Real Estate Investor Tax Guide. Check it out on Amazon.com. And can you get it on your website?
If you want to come to my website and request it there, we'll send you a free copy.
Okay, great, which is smarttaxadvisor.com.
Right.
You have more tax tips on his website. And remember, you can join Paul and other real estate professionals with tips just like this one right here on Real Estate Talk Boston.